Hey there, this is Chris Trapani, the Mortgage Pro. You know, I decided to do something a little different. Let's make a video that's going to cover the home buying process from A to Z. It's going to cover everything. So let's give this a shot. Let's see what we can do. I hope it's not too long, but you can always come back to it. Now, as always, if you enjoy this video, hit the like button and you can subscribe so you'll get all my new stuff and you'll learn how the process works and any new changes that come around in the industry. So let's start. We're going to go with step number one. Step number one. Here's how it works. People, it's a normal thing. Hey, I decided to buy a house. So they decide and they reach out to a realtor. Well, it kind of seems like it would make sense, but the first thing you really need to do is secure your financing. Because guess what the first thing that the realtor does? He sends you to me. So he can't show you a house or take you out or submit an offer or do anything until he knows you're approved, because way too often it's a waste of time for a realtor. So they make it a rule that they do not show houses pretty much until they know a borrower has been pre-approved. So how do we go through the pre-approval process? Well, what we need to do is we need to verify the most important things that are important to any lender on any loan program. And we start with this. Number one, your credit. Obviously, we have to run a credit report. No, we cannot actually do a full pre-approval if you show us just like a copy or a Credit Karma or whatnot. We actually have to run a mortgage credit report in your name, in our company's name, in order to do that. Now, what's important about credit? Well, there's a couple of things. Foreclosure. If you've had a foreclosure in the last 7 years on a conventional loan, or 3 years on a FHA loan, or 2 years on a VA loan, that would preclude you from doing that. So if you do have a foreclosure a couple of years ago, that just means maybe you can't get a conventional loan, but you could go FHA, or if the case is a VA. So that's not that big a problem. On a bankruptcy, see, this is a very common situation, is 4 years on a conventional loan, 2 years on an FHA or VA loan. So, hey, look, bad things happen to good people. If that was part of your past, look, just got to get past it. It's usually not too bad. So let's pretend you're past that and you do not have a bankruptcy or a foreclosure, or you're past that time frame. Now, what scores are acceptable? Well, on an FHA loan or a VA loan, you can sometimes get an approval, believe it or not, with as little as 500. Now, on a VA loan, you're really not going to get an approval with 0 down at a 500 score. And on an FHA loan, it would require a 10% down payment if your score is 579 or below. Now, once you start hitting 580 on either one of these type of programs, the approvals will become more and more commonplace. At 580 and above FHA, we're looking at a 3.5% down payment, and on a VA, it's still 0, and they've earned that right, and that's wonderful. Now, on a conventional loan, we're looking at a minimum of a 620 FICO score. At 620, you can be approved for a conventional loan. Now, very often, one borrower with a minimal down at 620 on a conventional loan won't get approved. Now, if you have more than one borrower, it looks at it as we have 2 people we can go to if there's a problem here. So we're looking at it and you're more likely to get it approved if you have a co-borrower with a very low FICO score. So now you know what you need to do with a FICO score. The next thing we need to do on a pre-approval is, obviously, we have to look at your income. What is your income? How is your income derived? How long have you been on the job? You don't have to be on a job for a long period of time. You could have gotten a first paycheck yesterday. Now, in most cases, we need to see a 2-year work history. It doesn't have to be the same job, but a 2-year work history, we have to prove that, whether it's FHA or conventional. Obviously, you can't be 18 years old, started your first job yesterday. It just doesn't work that way. Now, there are exceptions to the 2-year rule. Let me give you an example. If you were in school and you got a degree, Maybe you became a school teacher. Maybe you became a radiologist in a hospital, or an ultrasound technician. If you went to school, and we will need to see the transcripts, we will need to see the time frame. You went to school from this time to this time, and that will be acceptable instead of that 2 years. So I recently did a loan for a registered nurse. She went to school for 4 years. She got her first pay stub, and we funded the loan. Why? Because we used the 4 years as the history, and now her new income was $50 an hour. She's doing fantastic. Real proud of her. She's in her own home. So we can use that. Now, how do you get paid? Do you get paid salary? Well, salary is easy. If you get paid $5,000 a month, for income we use $5,000 a month. If you are paid hourly, what happens is we have to figure out how many hours you work. As an example, if you work 50 hours a week, you're working 10 hours overtime plus the 40 hours. First we start with the base pay, which is the 40 hours. And a simple way to figure that out is we work on monthly incomes. So if you're making $20 an hour, multiply whatever that hourly rate is by 173.333. That is 40 hours a week. That's how much you make monthly. So that's pretty simple. Now, if you work less than 40 hours, we're going to take an average over 2 years, because sometimes people work part-time jobs. Hey, did you work 20 hours this week, 22 the week before, 30 the week before, next week you're working 13? When we look at all these things, we have to average them out. We also have to average overtime over a period of 2 years. And if you get bonuses or commissions, again, over a 2-year period. See, income works in reverse. We look backwards pretty much in most cases to see how long have you been making this money. Now, it's okay if you get a raise, if you get a promotion. We'll use that higher income. But again, we're going to use the overtime or commission or bonuses going backwards, and we're going to average it out. If you are self-employed, this is going to be really super important. I don't care if you gross $1 million a year. That doesn't matter. What matters is what you pay taxes on. So if you gross $1 million and write off $999,000, you made $1,000, you're not going to be able to buy a pair of Nikes, never mind buy a house. So it depends on what you pay taxes on. There are such things called depreciation that your tax preparer might use. We're going to add that onto your income also. Sometimes people use their home and a tax preparer will write off some expenses in the use of the home. We get to add that back on. So let's say you grossed $100,000, but you had $50,000 in expenses. We're going to take 2 years of $50,000 last year, and how much is the year before? Oh, $47,000. That's $97,000. We're going to average that over a period of 24 months, and that's the allowable income that we use. That works for FHA, VA, and conventional loans. It works the same exact way.